Hey everybody, my name is Kyle Knott and I am not your average finance guy. Got a little artwork project I made here behind me. Sorry for the little bit of a glare, but wanted to take you through buying a cash flow asset versus in using the old-fashioned traditional savings account route versus the infinite banking concept. As most of you know, I'm a real estate investor. I'm a buy and hold forever type of guy, and this is how I use this amazing product to keep on growing my assets. The more cash flowing assets you buy, the more cash flow you have coming in every month, and pretty soon it's like a big snowball going down a mountain, and this thing just kind of runs itself. So let's go through it. I'm gonna get up here, and so your traditional savings here, what we normally do is we start by whatever, this is time, this is money, and what do? We save up for a certain amount of time, however long that is. I mean, this can be, I don't know, hours, days, weeks, months, whatever you want, quarters. So whenever you get to a certain amount of money, now you can buy a cash flowing asset. I would buy a rental property of some sort that's going to spin off positive cash flow every month, and it's going to help you to then build this back up faster. So as you can tell, these are a little bit higher. So all right, let's buy something here. What does that do to your cash that you have in your savings account? Boom, it takes it down. Probably not going to wipe it out. Maybe you will. I don't know. It takes it down to almost nothing. So it takes it way back down, and then whatever you were saving, okay, you're putting that in plus the cash flow of that other asset. So now you're building again. You see here, this is the interest. The green here is interest. If you're in a savings account, they're paying you 0.0 nothing is what I always say. So you're making a little bit. I mean, this is being very, very generous to what you're actually going to make in a savings account, general savings account. But this is how most people do it. This is how I did it when I first started. Nothing wrong with it. I'm going to show you a better way. Okay, so again, save, and then once you get that, you knock it all the way down almost to zero, right? So zero, and then we're going to save. We're going to chunk our way back up. It's going to go a little bit faster this time because now we've got two cash flowing assets that are going to help us build all of this interest or all of our assets back up. Again, it gets up to here. Buy another asset, boom, you're back down to nothing. So at this point, we've got three cash flowing assets. And let's say we're gonna, 1, 2, 3 times we did this. 3 times we saved up a good chunk of money and went down almost to zero every time, which means you're not hardly earning any sort of interest at that when you get to that point. All right, so if we come over here and we do the infinite banking concept, this is kind of what I'm making a lot of videos on this, and to me this makes perfect sense. So the infinite banking concept, it starts off, we're going to do the same thing, okay? Whatever we were saving here, this is just on a little bit different scale. So we're saving, and we're going to put it into this infinite banking concept. So it's going to go up little by little, and this is not to scale because this is so much bigger. So at this level here would be the amount you put in would be about the same. Okay, so you wouldn't be able to take all of this out in the first little while because of the way it's structured. But after you've got this going, if you're like me, a buy and hold forever type of guy, and you always want to put stuff away, I mean this will take off if you give it a little bit of time, just like anything. I mean this if you never bought any assets would take off the same way, but you're not earning any interest on it. Okay. So over here, same thing after we got 4 chunks of time, whether this is years or months or whatever it is, it's the same for both. So at this point, we're going to buy a cash flowing asset. What we're going to do is we're going to borrow against the cash value in this infinite banking concept. It's your bank. Basically, we're building your own banking system. So we're not going to take that money out. What we're going to do is we're going to borrow most of it against it. Okay, so this is a lot like your house. If you have a house that is worth $500,000, but you owe $250,000, you've got equity. You've got this asset that is worth more than what you owe. So you're able to maybe take out a home equity line of credit against it. And now what happens at the end of the year, if you take out a loan against your home equity, they don't come and cut your house in half. They leave the house intact. Here, we are leaving this infinite banking concept intact. So the next year we owe money, but we're going to keep taking, instead of building ourselves back up, we are now going to knock our loan back down. It's zero difference, okay? The money that we're putting in every period or whatever it is, however we're saving our money, all we're doing now is we're going to flip-flop it and we're going to pay down this loan because we're taking a loan against the cash value. And it's like, oh, no, I don't want to take out any loans. Stick with me here. This is all going to change real quick, okay? So at this point, another 4 units of time go by, same as over here, and we're going to buy another cash flowing asset right here. This, your savings, goes down to 0. This doesn't. We're just chipping away. We're chipping away at it. We're growing. Our cash value is growing. Okay. Here we're going to say it's the same value. So we're going to take the same loan, and we're going to, over the next 4 time periods, we're going to pay that loan down to nothing. We're paying the loan down to nothing. Look here. Here your money goes down to nothing. But look here, your cash value, once you get this thing rolling, it's kind of like an airplane that it takes a lot of power and you're at a dead stop and you're going down the runway, and here it is, the nose starts to lift, and pretty soon, I mean, you just take off, okay? So depending on how these things are set up, it can take I didn't put any time, I didn't put any money because everyone's situation is so different, but this is a general concept of how this works. So here again, okay, we got 1, 2, we're going to buy our third asset over here. Here's where we bought our third asset. Now, we've got 3 cash flowing assets at this point. Hopefully, maybe you're making $400 per asset. That's an extra $1,200 that over here we didn't have. Okay, so here we're still putting whatever we're putting into our savings plus maybe $400. So this goes up a little faster, and now here maybe it's this plus $800, and this goes up a little faster. And you could keep doing this. That's how I started out, because I didn't know about it. That's why I love this channel. I love teaching everyone about this stuff. Same thing here. Buy the asset, buy the asset, buy the asset. Look what's going on here. We didn't do it any justice, but look at this is dividends and guaranteed growth is all in the green. It starts slow, but then pretty soon it just takes off. So the dividends and cash flow, the guaranteed growth and dividends, last year my policy paid 6.64%, I believe. So that was all this, the dividends and the guaranteed growth. The guaranteed growth is 4%. Show me a savings account where you're going to get 4% right now. Maybe you can, but you're going to have to lock up $100,000 plus for probably 4 or 5 years, and then maybe you'll get that kind of a rate. But I haven't seen. I actually looked at bankrate.com the other day, and I think I found 4.4 for a 12-month CD, so maybe an 18-month CD. So you can't touch. What if the deal of a lifetime comes up and you don't have access to your money because it's stuck in a CD where you're making 4.4? Over here, you're guaranteed to make 4. And dividends, they pay dividends every year since almost the Civil War. And a lot of these companies, I think, have been paying for like 177 years or something. So they pay dividends every single year. Now, sometimes they're not as big as other years, but you're looking at 4+ anyway. It's not guaranteed, but 4% is guaranteed. It's by contract. They have to pay. These companies have been around for almost 200 years, and they have consistent track records of paying these dividends. To me, that's what it's all about. You never take your money out. It always stays in there. The growth of your cash value. This is like your house. If your house would continue to appreciate in value, now we don't know if our house is going to continue to appreciate or depreciate in value, but with this is guaranteed. It's guaranteed growth. Okay, it will. You can draw this out with pretty fair certainty, and we can do an illustration to show where you will be in 30, 50 years from now. And it's going to be pretty close. It's not guaranteed because the dividends can fluctuate up and down, but you will have a very good idea of where you will be at a certain amount of time. Okay? Show me that with your 401k. We're going to hope and pray that it makes 8% like it has since 1929. Well, how come they don't start since 1928? Yeah, because that was the Great Depression where everything went to hell. So they start everything since 1929. So what if there were to be another Great Depression? Your stock market goes to crap and we reset and redo everything. You lost everything. this thing, the IBC, these insurance companies were around through the Great Depression. Okay, 1867, I think. So 1860s was when Mass Mutual was formed, and that's since they've been paying dividends every year since the call it 1870, whatever. So they paid since 1870, just after the Civil War. They paid through the Great Depression. They paid the guarantees and they paid dividends. Now they may not have been huge, but they paid their guarantee plus some. So in my mind, this is a way safer scenario, way better way to go than sticking with the banks over here. How many banks collapsed even in the 08 crisis? And I know everyone gets the warm and fuzzy, you get the FDIC insurance, but trust me, there's not enough money in that FDIC insurance corporation to cover if something tragic happened. So this to me, a little bit of a visual of what I've kind of been talking and preaching. And again, there's nothing wrong with this, but if you want to get after assets and buy more assets, look at the loans that we're taking against our cash value here. Okay, they're down here. They're down here. They're down here. I tried to keep this somewhat the same as what the savings side was. But what's to say once you get down here, I mean, you could literally buy one, two, three. You could probably buy 3 or 4 assets at that time. And yes, now it might take you longer to pay that off because you've got a bigger loan against your cash value. But if it took you this long to buy 3, and the next year you can buy 4 more, and that's 7. Now, if you're cash flowing $400 times 7, now you're cash flowing, what's that, $2,800. That's more than what you had back here when you just started putting in your savings. So this is putting in the savings, and this is putting into this infinite banking concept. It's a premium. This is an insurance product, but it is life insurance, and that's where I lose a lot of people. That's where we lose a lot of people in this industry. But it's a tool. It's a vehicle. How is this not better than this? Oh, it's insurance. I don't want insurance. I call this the vehicle to make investments. I wouldn't really use this as an investment. I mean, you can. It's a very safe harbor investment if this is all you want to do and you never want to take loans out against it. But I want to buy assets, and I want to be able to pay these loans down faster and faster and faster. I mean, look what happens here. By the time you get this thing going for a while, your guaranteed growth and dividends will probably be more than what you would need to buy a cash flowing asset. So just take that and buy your asset. Let it roll. Pretty soon it all starts paying for itself, and you can take out loans against this for absolutely anything. You don't have to go down to the bank. You don't have to go get a credit check. You don't have to kiss the ring of the banker. You don't have to do anything. I get on my computer, push a couple buttons, and within a day or two, I've got a check in my bank, and it doesn't say why I want it. It doesn't. If there is cash value in here, they're contractually obligated to. You can take a loan out against it. So. End of story. They don't ask. It is super simple. If you get into, medical debt, maybe you want to use it for that. You can use it for that. Kids' school. This doesn't even show up on your FAFSA when you do your FAFSA for your kids' college. This doesn't show up. You don't have to list this as an asset. And you could have. There's people that have millions and millions of dollars, literally hundreds of millions, in these things, and they can. That's not me, but you can put hundreds of millions of dollars in this thing, and it does not show up as an asset, and you can use this for anything, whatever you want. Go buy a boat and RV, whatever you want. I mean, I would use it responsibly and buy cash flowing assets and get this thing paid back. Now, what happens if you're right here and you don't have this paid back and you die? Well, whatever your death benefit is, it's you get all that, your death benefit minus whatever you owe. So there you go. Super simple. What happens if you're right here and you die? Well, your family gets that. What happens if you die right here? Your family gets that, right? Death benefits over here it's up on the ceiling because they're so far off the chart. This is just what you have available access to in the cash value side of it. There's also an added death benefit because this is insurance that you get on top of all that. So as you can see, I'm pretty passionate about this stuff. So hit me up if you got any questions. Be happy to help. I love figuring this kind of stuff out, and show me the deal that you got, and I'll tell you what I would do. But you do you, and that's what this is. This is great. Everyone's different, and everyone can use this to their own advantage to whatever they want to do in in their financial lives. So, all right, I hope this helps, and let me know if you got any questions.